The 1st of April is when people play pranks on each other, and if you aren't careful, you can easily be conned. Actually, come to think of it, if you aren't careful, you can be suckered on any of the 365 days. But I find the 1st of April, or rather the entire month of April, a very good time to prepare oneself for the oncoming financial year. In this video, I shall be taking you through 10 essential tasks, a checklist of sorts that each of us needs to go through at the start of a financial year. This checklist will not only help you organize your finances better, but if done religiously, it will also go a long way in helping you achieve your financial goals faster and with a lot less stress. So let's begin. The union budget, which is announced in February, often comes with a number of changes in the country's tax laws. For instance, this year we saw changes in the income tax slabs. The tax rebate went up to 7 lakhs, actually 7.5 lakhs when we add the standard deduction. For HNIs, there was a reduction in the surcharge. For small businesses and self-employed people like me, the limits on presumptive taxation have been increased, and so on and so forth. So there were a number of changes, and the understanding and compliance to these should be treated on priority by each of us. For example, the point on old and new tax regime is an urgent and important one. It's urgent because as salaried individuals, your company's finance and payroll department will ask you to declare over the next 1 or 2 weeks which regime you want to go with. And it's important because your choice will determine how much will be your take-home salary and how much tax you might be paying for this financial year. Now, I'm not a tax advisor and neither am I a mind reader, but I have a feeling you don't want to pay more in taxes than what is officially required to be paid. So do read up more on these tax changes and its implications on the internet and be prepared. The beginning of a financial year is an appropriate time to review one's financial goals. Of course, it starts with a clear understanding of what those goals are, and I hope you've already listed them down in a diary or some online document that you can periodically review. But if you haven't started this process, then April is one fine month because it seems half of the office-going population in India are busy with planning and making PowerPoint presentations. So definitely there is much less execution stress for this month. But yes, if you already have the goals in place, you have a methodology of attaining them, then dedicate this first week to track where you stand and the progress you have made on those goals. It's an important task because a number of things might have changed over the previous year. For example, there are internal factors like your income might have changed, some new expenses might have propped up, some new goals might have come up in your life, you might have gotten married, you have a baby coming along the way, etc. Plus, there are some external factors also, like tax slabs that might have been changed, which affects your take-home salary. There might be inflation in the country. Maybe the car that you wanted to buy is now 15% costlier due to a rise in metal prices, etc. So stuff happens around us all the time, and it's always good to be prepared, which starts with an understanding of your goals, where you stand against each of those goals, and the changes you need to make to accomplish those goals. A similar and detailed review is recommended for your liabilities as well. After all, your income might have gone up, your savings might have dropped, the government might have forced a change in interest rates, etc. And what an evaluation of your loans is trying to do here is to get you to answer 3 simple questions. Number 1, given your projected income and expenses for the year, will you be able to pay all your loan installments in time? Because if you can't do that for any reason, then in a worst case scenario, your asset can be repossessed by the financier and you'll be running circles around lawyers for the rest of the year. The second question you want to answer is there an opportunity of foreclosing a loan that is prepaying some or all of the outstandings? Now, this is a desirable situation, and if you have a decent annual bonus coming in, then you can explore using a good chunk of that in expiring some part of your loan balance. And the third question is there an opportunity to reduce your installments by negotiating a better rate with the bank? You see, banking is a business and banks compete with each other all the time. So look out for opportunities to negotiate down the interest rate, and if your existing loan provider isn't relenting, then do explore using a balance transfer facility and moving your loan to someone else who can offer you a better deal. Alright, so a review of one's investment portfolio is a big topic in itself, and as I have said in a previous video, I personally do my own portfolio review in the months of February and March. But if you haven't been reviewing your portfolio or want to do it in a disciplined way, then start now, and there are three areas you need to take particular care of. The first is asset allocation, and I just released a detailed video on it. But to put it in a sentence, asset allocation is where you smartly divide your portfolio across different assets so that A, you can improve your returns, and B, you can simultaneously reduce the portfolio's volatility or risk, as it is generally called. So watch that video for specific strategies, but asset allocation is something that you cannot avoid. The second part of your review is around performance, and the idea here is to identify underperformers and of course instruments that have a better odds of doing well. This task will require you to understand the returns of each stock or mutual fund, the consistency of returns, the fund manager's investing style, valuation, balance sheet strength, growth estimates, etc. For example, and this is particularly in the case of a thematic fund or a cyclical stock, one needs to understand which part of the business cycle that particular stock or sector is at. Because if the cycle is at its peak and you end up holding that instrument, or worse, you end up buying more of it, then there is a decent chance of you making losses on that one, which also brings down your portfolio returns. And speaking of risk, the third and final step in your review is for you to rebalance your portfolio. So rebalancing simply means bringing back your portfolio back on track to your original asset allocation, which is done by selling some assets which have overperformed and buying some of the underperforming ones. This adjustment not only reduces variability in your portfolio, but studies also show that rebalancing also improves portfolio returns by up to 1%. Of course, while implementing it, it's important you understand and pay attention to some of the finer aspects, things like which fund, ETF or stock to buy, which ones to sell, the tax that's payable on capital gains, tax loss harvesting, which we have already discussed on this channel, the tolerance level, the exit load, etc. If you're going to do these three steps, that is asset allocation, performance review and rebalancing for the first time, then it might look a bit daunting, but believe me, it gets a lot easier when you do it the second or the third time. So try this out this April and let me know how it went in the comments box below. If you're getting good value from this video, then please do give this video a thumbs up. And if you aren't a subscriber yet, then do consider becoming one, as I can then serve you videos as soon as they are released and also share with you some investing strategies, tips and stories that I continually post in the community section. The month of April or maybe May is also the time when most salaried individuals receive their annual increments. Now, most financial advisors will tell you that an increment of 20% in your income equates to a 20% jump in your monthly SIPs. But I'll advise you to think of it more scientifically from this year onwards. In fact, let me explain this with an example. So say you receive that 20% increment and your monthly take-home salary goes from 1 lakh rupees to 1.2 lakh rupees. This means there's an extra 20,000 rupees that's available with you. Now, if you've been investing, say 10% of your salary towards an SIP, then using that traditional logic, you should increase the SIP amount from 10,000 to 12,000 rupees. But instead of doing that, try to understand this more from the perspective of that incremental 20,000 rupees. So if your expenses from this financial year are going to stay the way it is, then you have the entire 20,000 rupees at your disposal. Which means instead of doing a 12,000 rupee SIP, that is 10,000 plus 2,000, you can now do a 10,000 plus 20,000, that is a 30,000 rupee monthly SIP. This apportioning of a high amount early in your investing career can really jump up your wealth. And so while I say everyone should increase their monthly investment amount, it's also important to find better ways of doing that so that your wealth grows faster. There's an old saying that goes something like, you must pay taxes, but there is no law that says that you have to leave a tip. Tax planning as an activity ensures that you're not leaving money on the table. This is done as a combination of products, which generally includes an ELSS, some investments into NPS, the Public Provident Fund, and of course, life and health insurance policies. So it's basically section 80C and 80D, but if one looks beyond that, then there is a lot more to tax planning. For instance, there is tax loss harvesting, which reduces the tax you pay on capital gains. There are also deductions that you can take on home loan interest payments. There's also section 80E, which offers tax savings on the repayment of an education loan, etc. So as a taxpayer, it's important you understand each of these provisions and start working towards it as early in the financial year as possible. Of course, there is now this added confusion of a tax regime, and if that is getting over your head, then do explore utilizing the services of a chartered accountant or a tax advisor, as I have done. But never leave money on the table. The start of a financial year is also the time when a review of one's term insurance and health insurance policies is warranted. Why? Because a lot might have changed during the year. You might have had less or more dependents in your life. You might have relocated from a tier 3 town to a metro, which means your healthcare expenses are now bumped up. You could have taken additional liabilities like a home loan, etc. And these are internal factors, which means there are other factors like a medical inflation of 14% that also needs to be factored in our calculations. So if you're still sticking to the same 3 lakh rupee group health insurance policy for the last 20 years, then you're in for a rude shock, because the surgery that costed 1 lakh rupees in 2003 would now cost upwards of 13, maybe even 15 lakh rupees. In addition to these factors, I see insurance as an industry which is becoming more and more competitive. There are more players, more products, more innovation, which means it makes even more sense to understand what is available in the market today and then to review what your current policy offers versus what you really need in a policy. So take advantage of the changing times and try to find yourself a better deal this April. Next up is credit score. That is, you should check your credit score. Now you might be thinking, why would I want to do that if I'm not seeking a loan? It's a good question, but there are 2 good reasons why. Number 1, checking your credit report will help you identify any inaccurate information that might have crept into it, post which you can connect back with the credit bureau and rectify the problem. The second reason one should periodically check their credit report is to see if the credit score has improved. And if it has, then it gives you the option of receiving a better loan offer, a better interest rate from your existing or new loan provider. So have a check of your credit score, and now there are many platforms that even offer it for free. So do take advantage of that. Okay, so like birthdays and anniversaries, all financial events should be a part of your calendar. This will include things like the date of filing your income tax returns, the date on which you need to be submitting your documents to the company's payroll department, your PPF contribution date, the renewal date of your health and term insurance policies, the date on which you want to rebalance your investments, and many, many more other items. It's a very small thing to do, but the simple calendar of your financial tasks will go a long way in ensuring that you are disciplined and organized with your money, and it will also save you from many unnecessary complications in the future. And the final focus area for this financial year is for you to become more financially literate. Now, this is a good question that many people ask me. What do you really mean by financial literacy? And my simple answer to this is, financial literacy is a basic understanding of 6 financial matters. Number 1, how to budget your money. 2, how to set financial goals. Point number 3 is how to save money. Number 4, the basics of debt, which includes loans, credit cards, and credit scores. The next point is on taxes, that is how taxes work and how you can save a few. And point number 6 is on how investing works, especially the basic stuff, things like fixed deposits, NPS, mutual funds, sovereign gold bonds, etc. Of course, the importance of having an understanding of these 6 basic areas cannot be understated. So read books on personal finance, read the supporting material that I attach in the description of all my videos, watch my YouTube channel and some other channels I've listed on the screen here, and most importantly, be intellectually curious. If you have questions in your mind, then do hit Google or try ChatGPT and try to learn something new every week. Over time and with some repetition, a lot of it will become ingrained and habitual for you. And with this, I conclude our 10-point checklist on the things each of us should be doing at the start of every financial year. I hope you found some of this useful and will implement some of it. Once again, thank you for your time. Do like this video, do share it with your friends, and I'll see you next week. Until then.